Hi everybody, my name is Lucky and today we're gonna present about the week 4 seminar question, and me and Stephanie will go and present about and answer the first question, and Sherry and Joyce, they will present and answer the second question, and lastly Sylvia and Vivian will do the last question. And let's start. Yep. Hi everyone, my name is Lucky and me and Stephanie, we're gonna do question 4.18 from the homework question. So I'm not gonna read the whole question because I know you've done your homework. So this is some points from the questions. First, Carchip Ltd is a publicly listed company, so they need to present their financial reports to the external users. And then they also retail car parts and accessories, and they have 45 stores and 6 warehouses across Australia. And we as the audit team for the year ending 30th June 2015, we take part in the stock take and we note some of the following. Okay, so on part A, on 3 occasions, goods were counted correctly but recorded under the incorrect stock code. In each case, the incorrect stock code used related to a more expensive item than the good actually counted. Okay, so here we see that when we have a stock take, we counted the inventory or stocks that we have, okay? And here, the goods were counted correctly. So let's say we have 100 items or 100 of stock in our inventory, and we counted all of them. But then, some of them were recorded in the wrong stock code. And the incorrect stock code used is for more expensive item. There is some risk according to this, and it's gonna be in the next slide. Now we're gonna do the financial statement assertion. So first, we know that the account of fact is in inventory. And of course, in fact, inventory is a balance sheet item. And there are 4 assertions of risk in the balance sheet item. Is it its existence, right and obligation, completeness, and also valuation and allocation. There, as you can see from the question, you can know straight away that there is a valuation and allocation risk. But are there any other risks? So we're gonna start. First, for right and obligation assertion. All the inventory is owned by Carchip Ltd, so we know that there is no risk regarding to that. It's only allocated to the wrong stock code, but they still own the inventory overall. And then we know that valuation and allocation is at risk because the inventory has been misallocated to a more expensive item. And therefore, because of the misallocation, the value of the inventory is affected as well. And therefore, inventory account is overstated. Next, for existence. For existence, there might be a risk for existence and also the completeness of the financial report, as some of the stocks are left unrecorded. I'll move to there. As we said before, the existence and completeness of the financial audit might be at risk. So let's say that Carchip Ltd, they own 100 items in their inventory. And there are 50 of item A and 50 of item B. Okay. And let's say A is the more expensive item, so it costs $100, and this one only costs like $70. And in part A, they said that they put a wrong item in the wrong stock code. Let's say they put B as A. So actually in the financial report, they actually have hundreds of A and no B. And this is where existence and completeness might be at risk. Let's say, in the financial report, they have hundreds of A, but in reality, they only have 50 of this item, of item A. And where did the other 50 go? That's the existence problem, and it might be at risk of material misstatement. But on the other hand, they have no item B in their financial report, and there are actually 50 of this item in existence. Therefore, their financial report is incomplete. That's my part, and I think Stephanie will continue and take on part B. Thank you.
Yep, so in this question, a large amount of stock was transferred from Adelaide to Melbourne and Sydney warehouses. The items transferred have been recorded as inventory in Adelaide and also at the locations received. There is an important detail that I have noted from this question, which that the items transferred is being recorded as inventory in Adelaide. It is quite strange that the inventory is being recorded as it is transferred out of the warehouse. So in the next slide, the account affected is inventory, and inventory is a balance sheet item. Therefore, these are the potential financial statement assertion. I will list you one by one the assertion risk regarding the question. So firstly, I'll talk about the right and obligation assertion risk. This one is not a risk because Carship Ltd has legal rights of ownership to the inventory. And secondly is completeness is also not a risk because the inventories that should have been recorded. Thirdly, I will talk about existence. This one is a risk because the inventory included in the balance sheet physically does not exist. And lastly is valuation and allocation. This one might be a risk because the inventory account is overstated. Therefore, value of the inventory is at risk of material misstatement. So that's it from me.
Hi, I'm Sherry. Today, Joyce and I are going to present case 2.1 on page 38. First of all, I'm not gonna read the whole case in this slide, but instead I prefer to analyze some sentences that relate to the risks at the end of this question, which are risks from A to D. So let's start with first sentence. The bookkeeper undertakes all invoicing and banking along with follow-up of any outstanding accounts. It is quite clear that because of non-segregation of duty, this bookkeeper has to take responsibility of all those tasks. So it might generate issues like payment being made twice to the same supplier. Also, not in time following up of any outstanding accounts may cause business have more bad debts. Then the next sentence is overtime is often worked on weekends by all staff. The risk here could be overpayment of overtime to the employees. And the last part I would like to expand is inventory is stored in the Speedway warehouse, which is accessible by all staff on an as-needs basis. And the risk in this situation is quite straightforward, which is inventory being stolen. Now I'm going to present the practical internal control and test of control for risk A and B. Then Joyce will do the rest later. For risk A, non-collectability of debts, we usually call them bad debts as well, in order to avoid them or prevent them from happening again. Both protective control and detective control should be used. For the first internal control I can think of is establishing policy of authorization of credit and terms. Firstly, I would say it's a preventive control. Secondly, apart from doing this, business should ensure the customer's credit limit check before each sale to make sure that the credit limit will not be exceeded. To some extent, bad debts may be reduced through those strict credit approval procedures. To test this control is valid or not, the test we can use is reviewing sales transactions to ensure that each sales was made to customers within the credit limit. Besides, the business can appoint someone to supervise the process of credit approvals. And the second control I had in mind is reviewing aged accounts receivable, listing on a monthly basis, and ensuring appropriate follow-up action taken for overdue amounts. And I would say it's a detective control because those overdue amounts already appeared on the financial report. To test this control, we can expect the record of preparing aged accounts receivables and following up outstanding accounts. Now let's move to risk B, which is potential understatement of revenue. For this risk, in the question, it mentioned an example of a 15-meter yacht being invoiced for sleeping 10 meters. Then the first internal control I came up with is Sleepway manager should have spot checks from time to time to see any difference between data in invoice and actual sleeping distance. To test this control, the business can inspect whether Speedway manager conducts spot checks or not. Also, we can examine or review the paperwork to see the results of completing those checks. Then the next control pop into my head is more technical, which is applying statistics to calculate variances based on regular amount of flow slip. To test this control, the business can apply some, they can apply some statistics software like Gritto or something else to analyze results and check into those variances. And that's the end of my part. Thanks for listening. Now I will pass it to Joyce.
Everyone, I'm Joyce. Now I'm taking over the remaining part of question 2. So part C is about the risk of overpayment of overtime to employees. The internal control I will give is that the overtime work must to be authorized by the managers. The companies could also carry on a policies which establish the maximum hours for each employees. As an auditor, when we doing a test of controls, we can review the sample of work schedule to ensure that any overtime work have actually been authorized by the managers. And also, by reviewing the sample, we can ensure that no employees has been working over the maximum hours according to the policy. Let's move to part D, inventory being stolen. For the internal control, the companies can do regular stock take, restrict access to warehouse. They could also apply for physical controls such as security cameras or maybe just a lock for the door. For a test of control, the auditor can observe the stock taking to ensure that all of the inventory have been recorded properly. And we can also observe working of physical access controls. Here comes to my final part, payments being made twice to the same employees. We are looking for the internal controls such as payments are made monthly on the basis of suppliers' reconciled statements only. Also, the cancellation of the supporting documents while preparation of such payments. For a test of controls, the auditors can inspect payments to ensure that they were being paid on the basis of suppliers' reconciled statements only. By inspecting such a sample of payments, we can also ensure that all of the supporting documents have already been cancelled. Yeah, that's it for my part. Now I will pass the presentation to question 3. Thank you for listening.
Hi, I'm Zero Yao. I'm going to talk about 2 of the potential risks in our question, which are potential bad debts and mistakes of reconciliation of bank accounts. These potential risks can be identified and addressed by internal control process of the management in order to improve the reliability of financial reporting, effectiveness and efficiency of its operations, and compliance of regulations. Potential bad debts are related to valuation and allocation, which requires that assets, liabilities, and equity interests are included in the financial reports at appropriate amounts, and any other resulting variation and allocation adjustments are appropriately recorded. Potential mistakes of reconciliation and bank accounts are related to accuracy of financial information, which requires that amounts and other data relating to recorded transactions and events have been recorded appropriately. Um, in our question, the company have more than 100 clients purchasing boats of cars on credit, and the credit terms are not 30 days. This means that there might be some bad debts at the end of term because some payments may not be collected. My recommendation for preventive control is to establish policy of credit and terms to ensure that customers' credit limit check before each sale. The company should ensure customers' credit limit, and when customers purchase products on credit, record of these purchases should be clear and correct, and specific employees should be responsible for the following collection of payments. The detective control is to review each accounts receivable that is listing on the monthly base for evidence of non-payment and ensure appropriate follow-up action taken for overdue amounts. This practice can ensure that accurate statements of accounts receivable and bad debts. Another possible risk is that one of their employees, Sarah, is responsible for using the bank stamp deposit slip to write up the cash received books weekly, as well as preparing for reconciliation of bank accounts, which means that amounts and other information may be recorded and transferred inappropriately. My recommendation for preventive control is to establish mechanism of complete information collection in the first place to reduce mistakes of recorded financial data, including sales, inventory, accounts receivable, and so on. The detective control is to review auditing control after reconciliation of bank accounts. And that's all of my part, and thank you for listening. And my group partner Vivian is going to present the rest of the question. Thank you for listening.
Hi, I'm Vivian, and I'm going to talk about the other two risks that I have observed from the question. First of all, I will say there is the risk of incomplete transactions. According to the question, we know that the payment mostly made by mails and also paid over the counters. There is the risk of incomplete transactions, especially when orders have been highly increased. Mary Letters, who is responsible to manage payment received, would be the main cause of this risk. First of all, Mary needs to open the mails and select and separate payment on account from other mails. Except for the high volume of the payment mails, the email account also has received many other general mails. It would be difficult for Mary to select all payment-related mails from tons of the others. Therefore, the risk of negligence would occur, and some payments would be missed out and not be recorded. Besides, she needs to collect money, which comes directly over the counters. Since there is a marked increase in the volume of both mail coming into office and individual pays over the counters, it would be too confused for her to handle payment from different sources manually. The problem of payment not being recorded and losing payment would be occurred, and thus the financial statement is not complete. For the internal control to mitigate this risk, it can be divided into preventive control and detective control. For the preventive control, we can develop an official email account which aims to receive clients' payments. Therefore, all payments can be completely recorded by referring to the email. Moreover, segregation of duties and responsibility would also minimize the risk, since Mary can just focus on handling mail payments and the other can focus on handling payments over the counters, which ensure the completeness of the financial statement. For the detective control, it would be better for the company to have monthly review of payment received by appropriate manager to compare payment received with the number of boxes of cards sold. Therefore, errors can be detected in an earlier way and correct it immediately. For the test of control, the auditor will observe and evaluate whether proper segregation of duties is operating. Furthermore, they will inspect the open order file for unfilled orders and file recorded sales to supporting documents. And secondly, I will say there is the risk of theft and embezzlement. Since the key to safe is held by the accountant clerk, Sarah Post, and she will take the money to the bank, the risk of theft and embezzlement will occur. Since the all money is controlled by Sarah, it will be easy for her to steal the money as she can manipulate accounts of the financial statements in order to hide her offense. Even though she will not tend to steal the money, it was still risky for just only relying on her to keep the keys and also deposit large amount of money to the bank. Because if she lost the key or being robbed during funds transportation, the company will have a big loss on their total revenue. For the preventive control to minimize this risk, the company should authorize another staff to manage the money and set a password for money access, except for just using the key. Moreover, in some instances, a depository bank unmoored vehicle is requested to pick up the deposit to ensure the security of transportation. For the detective control, a security camera would be a good example. For example, if a store manager who noticed a pattern of a cash drawer coming up short when attended by a particular clerk can easily look at video of the clerk's action throughout the day to detect potential theft. Moreover, an access log and an alert system can quickly detect and notify management of attempts by employees or outsiders to access unauthorized information or parts of the buildings. For the test of control, the auditor will examine application controls for authorization, and there is and they may observe and evaluate whether there is proper segregation of duties is operating or not. And this is the end of our presentation. Thank you.